Hi everyone, I'm Susan Galinsky.
And I'm Denise Grace, and we're the founders of G Squared. So for the best information and advice on how you can have a successful retirement, please be sure and subscribe to our YouTube channel and hit the notification bell so you'll be notified anytime we upload a new video. So today's topic, when should you file for Social Security? Is it 62, 66, or 70, or somewhere in between? There are literally hundreds of different ways you can claim your benefits from a strategic standpoint. So how are you going to figure out what is the best option for you? And more important, how do you not just maximize, but optimize, meaning protecting your income, your Social Security benefits from that stealth Social Security taxation. So by the end of this video, you'll have a better understanding on the claiming options that are available to you and how can you make that best choice that suits you best. And don't forget, we're always available to help. So just click on the Calendly link below and schedule a quick chat with us. We'd love to talk to you.
Absolutely. Thank you, Denise. So as Denise said, Social Security is an important part of your retirement. And obviously, you've paid a lot into Social Security taxes over the years, so you want to get your maximum benefit. And it ends up being, for a lot of people, a big part of their retirement. I think it's almost 50% rely on that as their sole income. Yeah. So you need to understand your filing options. And another thing we'll talk about today is that a lot of people are fearful, will it be there for them long term? So, and then questions about spousal benefits. So to that point, I'm going to show you a slide now. And this is showing you the Social Security statement. So obviously, you can do this online. They're available at that address that you see. But the first thing you want to do is check for accuracy. So are all of your years that you worked, are those earnings correct? So first and foremost, check that. Now on this next slide, there's three numbers there that you're going to look at. Your primary amount that you would get, which is at your full retirement age. If you filed early, 62, what that amount would be. And then of course if you waited till age 70, then that would show you the full amount that you would get. And of course, this is dependent too upon when you file, because obviously inflation and cost of living will be factored in here dependent upon the year that you actually file. So on this next slide, you can see that Social Security just plays a small part of the total retirement income puzzle, because we might have other retirement assets such as a pension, a 401k account, or a thrift savings plan if you're a federal employee. And of course, those monies can be turned into other opportunities like private pensions.
Right.
But you're going to look at what are your income needs when you do stop working. And of course, you're still probably going to have money in the market to stay current with inflation. And you need to look at your risk tolerance, because as we get older and we're no longer working, we can't afford to take as much risk as we did when we were younger. And so your goals and your challenges are going to play into this puzzle too. So today we're going to look at all those different areas and how you can figure out what works best for your individual retirement plan. So going back to sources of income, as I said, you're going to have your Social Security. You're also going to have any income that you're getting from money that you may have in the market, the pension, could be rental income, could be royalties, whatever. Retirement benefits, that's your corporate pension. And then you may also decide that you're going to continue to work. And a lot of people do, even after they have filed for Social Security. All right, so how do we become eligible for Social Security? Well, this is going to go back to your online record. But normally, the way that you can be eligible is you have 40 credits or quarters of coverage, which is roughly 10 years. And one credit in 2023 equals 1640 in earnings. And you may earn a maximum of 4 per year. For those who maybe were a stay-at-home mom or dad, if you lack the 40 credits to be entitled, you still may be entitled on someone else's record, such as your spouse.
Right, and they don't have to be consecutive 10 years. It's just quarters, and they add the quarters up each year.
That's a really good point, Denise.
So how do they determine your benefit? Well, they take your highest 35 years of earnings, including zeros. And they go through some calculations kind of in the background to determine what your primary insurance amount is. Primary insurance amount being what you will get at your full retirement age. So those 0 years, if you've got earnings or years where you haven't earned anything, you might want to consider, just working a couple more years. If you've got zeros or if you've got some lower earning years back in the beginning, because every lower earning or 0 year that you replace can up the amount that you'll collect at your full retirement age. And the full retirement age, the maximum that you can get in 2023 is $3,627. Again, that number is adjusted every year for inflation. What happens if you decide to claim Social Security early, say at 62, and in this case a full retirement age of 66, you're going to take a 25% cut in your benefit. Keep in mind that cut stays with you for the rest of your life. It also is affected by cost of living adjustments. Those COLA adjustments are going to be based on that smaller figure. Also notice if you wait past your full retirement age, for every year that you wait, your benefit is going to go up by 8%. So in the case of a full retirement age of 66, that's another 32% on top of your primary insurance amount. So that's pretty significant. Now let's look at what happens if your full retirement age is 67. It's a little bit different, a little bit lower numbers. In this case, if you claim early, you're going to take a 30% cut. So you're only going to get 70% of your benefit. And again, for every year that you wait past age 67, you're going to get that 8% bump up in your benefit. So let's look at what happens if you claim early and you continue to work. Before you reach for retirement age, for anything that you earn, and this is earned income only, anything that you earn over $21,240, you're going to pay back Social Security $1 for every $2 in benefits that you receive. In the year that you reach for retirement age, that number goes up all the way up to $56,520, and it's $1 for every 3 that you earn. In the month that you turn full retirement age, and any time after that, you can earn as much as you want. But it's something to keep in mind, because particularly for those who claim early and then decide that they want to or have to go back to work, that's something that you need to factor into your plan.
All right, so let's talk about income taxes. And I think this is kind of a surprise for some people, because your Social Security can actually get taxed. In fact, up to 85% of your benefits may get taxed. So what is it calculated on? Well, it's called combined income. And how they do that calculation is they take your adjusted gross income, they add any non-taxable interest, so this could be municipal bonds, etc., plus 50% of whatever you received in Social Security, and then that becomes your combined income. Now, one thing I might say about that, the only thing that isn't included in this combined income is anything that you may take out of a Roth IRA. So if you took any withdrawals in the year, that wouldn't be included. So how do they calculate the income taxes? It's based on whether you're single or married, obviously. So, and I think the one thing that is probably discouraging or a little upsetting about this is that these tables that they haven't been updated since 1984. So when you think about that and how wages have obviously increased since 1984, that means you've got a bigger and bigger pool of people who this is going to affect going forward. So if you're single or head of household, you're going to get a 50% taxable if you have more than $25,000 in combined income, and 85% taxable if you're over $34,000 in your combined income. Married filing joint, you have the same percentages, but the amounts of combined income obviously go up. 32,000, 50% taxable. 44,000, 85% taxable.
Right.
And this is what they call
The stealth tax.
the stealth tax.
Because
Yep.
it sneaks up on people. Most people aren't expecting it. It doesn't come into play until you start claiming Social Security.
Yeah.
So let's look at some of the options for claiming benefits. Benefits that are available for spouses. A non-qualifying spouse. A non-qualifying simply means that you don't have those 40 credits to qualify for your own benefit, or in some cases your benefit is significantly lower than your spouse's. You can collect on the record of your qualifying spouse if the following conditions are met. You have to be 62 years or older, or any age if you're caring for a qualifying dependent. If you've been married at least 1 year, and your spouse is currently receiving his or her benefit. So the spousal benefit is equal to 50% of your spouse's primary insurance amount. That's the amount that he or she would collect at their full retirement age. There is a reduction if you claim early, just like we showed on those charts a little bit earlier. If you claim 62, you're going to take a 25 to 30% cut in your benefit. The other new rule is your spouse has to have filed and be collecting his or her own benefits. So the benefits for former spouses, if you're divorced, they're quite similar to spousal benefits with a couple exceptions. Your marriage has to have lasted at least 10 years. You have to be currently unmarried, 62 years of age, and your former spouse has filed and are claiming his or her own benefit. The exception to that, say if you have a former spouse who's waiting to age 70 to collect their benefits, if you have been divorced for at least 10 years, you can go ahead and file on that former spouse.
Isn't that if you've been divorced for at least 2 years? Not 10?
2 years.
Yeah, you said 10.
Oh,
Okay.
I'm thinking
Just,
that, yeah.
okay, we clarified. All right. And then the other thing is, people worry about privacy. Talk about that a little bit.
Well,
will their spouse know that
And
they
a lot of
filed?
people are worried about, will my ex-spouse know? Do I need my ex-spouse's permission? The
Right.
answer is no and no. It has no impact on your former spouse's benefit. Your former spouse does not even have to know unless you tell them that you're claiming on their benefit.
Right.
Survivor benefits are the only thing that didn't change with the 2015 rules. And they're a lot more liberal as well, a lot more lenient. You can actually claim a benefit as early as age 60, or if you're age 50 and you were disabled, like I said, within 7 years of your spouse's death, or at any age if you have eligible children. So how much can you receive as a widow or widower? You're eligible for 100% of what your deceased spouse's benefit would be at full retirement age if they were still alive. A big difference here, though, is if your spouse delayed their
Benefits?
benefit and waited until age 70, you are entitled to that full amount. This is the only time that takes effect. And thank goodness it's something that wasn't taken away in the 2018 rules. So if you've got a spouse and you're kind of considering, should I wait, you're significantly older than your other spouse, you may really want to consider delaying your benefit until age 70, because that higher number is the amount that your widow or widower is going to collect if something happens
And
to
I
you.
think that's a really important point. So let's reiterate that again. When you are married and you're waiting and you're deciding, do I want to file at 62 or do I want to file at full retirement age, and you made significantly more in your overtime lifetime of employment than your spouse did, think about the fact that if you should die before them, then they're either going to get the reduced amount or they're going to get the full retirement amount.
They're going to get the full retirement plus those delayed retirement credits of 8% a year for
Right.
waiting until age 70. The survivor, they can also take benefits at your full retirement age or sooner, but they will be delayed. Another big exception here from all the other claiming strategies is if you're a widow or widower and you claim your benefit early, even as young as age 60, you're claiming that survivor benefit that does not affect your own personal benefit. So what can happen is you can claim early, collect your survivor benefit, and switch over to your own benefit when you turn 70 and take advantage of those delayed retirement credits if that method comes up with a higher number for you.
Okay, so I want to reiterate here again. So back to this first, on your left, survivor benefit. You're eligible for 100% of what your deceased spouse would receive if still alive, if taken at full retirement age. However, if that spouse filed at 62 and now he or she died, let's say at 68, you're going to be eligible for what they received, their amount at age 62, because they took it early.
Mm-hmm.
So that's the point that I'm trying to make, is when you have a spouse who made more than you do, they should really look at, if they decide to file early, they potentially are reducing the amount that you're going to get if they should predecease you.
Right.
Right? Okay. Glad we got that
We
clarified. All right, so here's a hot topic, right? With our government spending money like it grows on trees, will Social Security be there still for you? Well, that's a really great question. And
They're not going to raise it from 62 because that's when they pay out the least amount. They're talking about raising it from 67 to 69.
yeah,
Because
but
if
think
they
about
pay-
it. But think about it.
That's what that new proposal says.
Is the new retirement age for early, instead of it being 62, could be 65. That
Would be early with a 30% cut.
Right,
Yeah.
that's what I mean. So then, of course, the other way they could do it is, we all know that there's an amount that you have to pay Social Security tax on when you're gainfully employed,
Mhm.
and then that there's a limit, though.
There's a
More
threshold. Yeah.
income limit. Well, they could raise that significantly.
As they have in the past.
Right. So those are a couple ways that they would probably address the shortfall, because Social Security, they know, is a very hot topic, and we'd have some mass rebellion on our hands
Right.
if they even looked at decreasing the amount that you're currently getting.
Right.
All right, so this next slide really says, you know what, let's focus on what's more important, and that is, how much of your retirement income are you going to keep? Because taxes, there's a very high probability that taxes are going to go up in the future. So what is your plan for when those taxes do go up? And we have some people who delay their Social Security and instead start accessing their retirement accounts.
Spend down those qualified dollars, right?
Right,
Mhm.
right. Because that way you're going to be able in the long run to keep more. And that really should be what your retirement goal is. So bottom line is, optimize by avoiding taxation. And at G Squared, that's something that we help our clients with every day.
Mhm.
So as we go forward and we end this webinar, I want you to think about your to-do list, which is, first of all, you're going to check your Social Security statement online on a regular basis.
Check it for accuracy all
Absolutely.
the time.
The second would be, consider those other sources of income and how that could impact your taxation rate when you go into retirement. Third, be aware of ways to enhance the benefits to which you may be entitled, and we went over a few of those today in our presentation. And then, most importantly, schedule an appointment with us so that we can help you optimize your Social Security while minimize taxation. And we always do that through a written retirement plan. So it doesn't have to be complicated. I want you to think about that first. So in closing, if you would like to discuss your options, please feel free to contact us. Just click on the Calendly link below, see what time, no obligation, 15-minute consult. It could be enlightening. And as always, we encourage you to share this video with your family and friends. If there's any topics that you would like discussed, then just message us, let us know.
Put them in the comments.
Yeah,
We'll
we're always
take a look at it.
absolutely, we're receptive. And of course, we always end by letting you know that we appreciate you, and at G Squared that we value building relationships
Beyond investing.